Hi, welcome to Chapter 11, Evaluation and Control. Today we're going to look at the tools and techniques managers use to evaluate and control for their mission statement and strategic objectives. The first thing managers have to discover is what to measure. Then establish the standards, measure performance. If the performance does not match the standards, take corrective action and measure again. If it does match standards, then stop. That's the basic flow chart of evaluation and control. Now, performance is the end result of an activity. Just like when you run a race, play a video game, it's all about the results. And steering controls are ways to measure variables that influence the profitability. So we want to look at different industries have different measures and different costs. So, for the airline industry, you'd look at cost per available seat mile. Retail, you might look at inventory turnover ratio. And for many industries, you would look at customer satisfaction. Now, there's three types of controls: output, behavior, and input. So output controls, you're looking at what's been accomplished. You're focusing on the end results. So the output, what the sales are, the profits, customer satisfaction. Behavior controls are going to specify how things are going to be done through standard objectives, policies, rules, operating procedures from supervisors. So the company and supervisors will set up guidelines or standard operating procedures, and that's to control employees' direction behavior during the work process. Input controls are going to emphasize your resources, the inputs to the materials for the products, the inputs to the labor of the people, so whatever is going into the process of the company. Now, activity-based costing is a costing method where you're going to look at all of the direct and indirect costs. So an indirect cost would be overhead, labor from indirect people who work in sales, people work in accounting and finance and human resources. Direct costs are the direct material components and the people who work directly on making the products in the factory. So people who are assembling the products, crafting, creating, making the products. So you take all those costs, the indirect and direct costs, and you allocate them directly to individual products or individual product lines. And you look at the value-added activities going into the product. So you'll say, here's a tube of toothpaste. We need to know what's its share of the allocation. So if you're looking at overhead and indirect labor, you make a big pool, and if all the company makes is this one toothpaste, you divide that money, maybe it's $5 million, divided by the amount of toothpaste tubes. Maybe you make 20 million toothpaste tubes, so each toothpaste tube has an indirect cost of 25 cents. Then the direct cost would be the actual materials, the packaging, someone putting it in the box, the labor for putting the cap on, putting it in the box, stocking it. Those will all be direct labors. So you'd add it up together, and then you could go back and say, okay, what is the biggest cost to this component? If the overhead indirect piece is too big, can we get a cheaper facility, lay off some people? If the material costs, the direct material costs are too expensive, maybe we can find some substitute ingredients. All right, so this will allow accountants to charge costs more accurately and allocate overhead more precisely to the product level, so you truly have an idea of how profitable the product is. Enterprise risk management, this is a company-wide look at processes that management would deem risky or uncertainties that could negatively or positively influence the achievement of objectives. So enterprise risk management is really just trying to put a measurable risk on all the activities of the company, everything that could go right and go wrong, and really just getting a good what-if scenario for the company and try to manage those risks and say, okay, if this one area, if we have a lot of foreign currency, and the foreign currency is very risky because it's volatile, that's an enterprise risk affecting our foreign sales. Well, we identify the risk, the chances of it to go positive or negative, and then maybe hedge our bets with some future contracts. Okay, so here's a process of rating risks involves in 3 steps. 1, identifying the risk and using a scenario analysis, brainstorming or performing a risk assessment. So a scenario analysis is sort of a what-if analysis. What if this happens? What if the currency goes up 10%? What if New York passes a law that we have to pay our fast food workers $15 an hour? So we want to identify the different scenarios. We could brainstorm and think of possibilities that, other possible risks, and then the risk assessment. What is going to be the total loss and profits if we do have to pay $15 an hour, or if the currency does go up 10%? Then we could rank the risks using a scale of impact and likelihood, or a combination of both. So it's very likely that this will occur, and the impact is minimal. Or it could be very unlikely they'll pass a law to make a $15 per hour minimum wage. However, the impact would hit us significantly. So that we have to rank it based on a combination of those elements. And then we would measure the risks using some agreed upon standard. So we would really, each company is different, and we'd find some standard that we would agree as a way to measure the risks. Now, traditional financial measures of risk, we could look at return on investments. And this is a result of dividing the net income before tax by the total amount of money invested in the company. And that could be sometimes measured by total assets. So gives us an idea of how well we're doing as far as the return on assets. Earnings per share, dividing the net earnings by the amount of common stock, and this gives us the amount of earnings we're earning per share. And this is very important to investors, and it's a good way to measure how well the company's doing. In fact, for most companies, their stock price is closely tied to the performance of the earnings per share. We also have return on equity. And here we're looking at net income divided by total equity. And what we're trying to find out here is equity is the money investors have invested in the company. So dividing the net income by the equity, we get a better idea of how well our money is doing. So if I invest $1 million in a business, and the business makes $2 million in profits, my equity is doing pretty well. However, I may have invested $1 million of my own money in the business and borrowed $99 million from the bank. So I have a relatively small equity, which makes it easy for me to have a high return on equity. We could also look at operating cash flow, and this is going to measure the amount of money generated by the company before the cost of financing and taxes. So operating cash flow is sort of like an operational cash flow, or the true money the business generates, ignoring interest and taxes. That's what the cost of finance is generally interest. Give us a better idea of how the company is generating income. And free cash flow is the amount of money an owner can take out of the firm without hurting the business. So free cash flow is the money that we could easily take out of the business after we have a certain cash balance and all our bills are paid and things like that. So free cash flow is a little bit closer to, if I own, say, a laundromat, how much money could I earn every month or take out of the business, and the business could still operate and be maintained and move forward and even grow in some cases. Okay, non-financial performance measures used by various internet business ventures. Stickiness, the length that someone stays at the website, visits the website, or utilizes the website. Eyeballs, the number of people who visit the website. And brand awareness, the mind share. So branding is very important in today's business world. You want people to be familiar with your brand. When you say a brand, you want them to recognize it and the strengths of the brand. And that takes a lot of advertising, and it takes a lot of consumer experience with the brand to really know what the brand is all about. Now, a brand, just like, think of a hot brand that you would sear into a cow, and you mark that cow with your brand if you're a rancher. In sort of the same way that ranchers will brand an animal, you've been branded by corporations without even you knowing it. They've secretly got into your mind and branded their product in your brain. If you have an opinion that Coke is better than Pepsi or Pepsi is better than Coke, you've been branded. If you like Nike better than Under Armour, you've been branded. If you like one Kellogg's better than General Mills cereal, or you prefer one brand, any situation where you prefer one brand over the other, you've been branded successfully by the company. And that's typically a very difficult thing to do. But once you have achieved a brand, there's some people who say that, I like McDonald's, I hate Burger King. And people who only like Burger King hate McDonald's. It's not that, in reality, it's not so much the food or the products. It's how much the marketing or the branding has affected you personally and emotionally to make you connected to that product. Commercials work very well, and they can really affect how you feel about a product or a company. We also want to look at shareholder value. So shareholder value, if we take the net present value, something you learned in the finance class, of the anticipated cash flow, and plus the value of the business if it was liquidated, we can get a value of the company in today's terms. So if we took a company and said we project it to make $10 million a year for the next 5 years, and if we sell the company in 5 years, you can get $50 million of equity from it. Discounting all that money into today's dollars, we would know what the actual shareholder value of a company is. And if the company is continually increasing this value, you know that they're performing well. Now, economic value added is something that I do cover when I teach finance, and it's a measure of the difference between pre-strategy and post-strategy values for the business. So what we're looking at is after-tax operating income minus the total annual cost of capital. So what that means is we want the operating income, the after-tax operating income. So we find our operating income, subtract our taxes from it, and then on the other side we take our total cost of capital. And cost of capital, if you remember from the finance class, can be cost of equity, cost of long-term debt, cost of short-term debt, cost of preferred bonds. We have we get a total amount of money that the capital that the company has raised, whether it issued stock or preferred stock or bonds or took bank notes. This is all money is capital. So the total money that the company has taken from investors, we look at the cost of that capital, and each piece of capital has a specific cost. So we total up all the cost of capital, and if that's smaller than the operating net income after tax, the company has created economic value. Now, market economic value takes it one step further. We look at the difference between the market value of a corporation and the capital contributed by shareholders and lenders. So we look at when we say the market value, it's the outstanding shares of stock times the share price, gives us the total market value or market capitalization of the company, and we subtract from that the capital contributed to the company. So if the company has grown the stock faster than the capital they've borrowed, they're increasing the market value of the company, and that's a good measure of performance. All right. A balanced scorecard. If you've used the Zoom simulation in the finance class, there was an overview point system, and that's basically a balanced scorecard, which combines, this is probably the only example I can give you that you'd be familiar with, because is that Zoom simulation, how they score the Zoom simulation you played in the finance class. And yeah, that's looking at the financial results with operating measures and also looking at managerial measures as well. Now, some balanced scorecards, they can be different. They're not all the same. Some do include customer satisfaction measures, corporate innovation, improvement activities, and these are drivers of financial performance. Although the Zoom simulation did have the amount of money you invested in operational investments, so that would be an example of improvement activity, spending more money to upgrade plant and equipment, get robotics, upgrade your software. And this is a way of looking at many different areas of the company to create a balanced scorecard to see how they're doing in all these different areas from year over year. So the balanced scorecard helps managers develop goals and objectives in 4 specific areas. Financial, how do we appear to shareholders? So this would be a lot of the financial ratios: total asset turnover, return on equity, return on assets, net profits, gross profits, operational profits, quick ratio, all those types of information. Customers, how do they view us? This could come from customer surveys and how customers are feeling about the brand, about the product, about their experience. Internal business perspective, what does the company excel at internally? What are their best business practices? Innovation and learning, and this can be a measure of how research and development, how productive has research development been in developing innovative enhancements to the business, the products. And learning can be looked at what type of training have the employees gone through. Have they taken advantage of tuition assistance, training programs, conferences, things of that nature. Key performance measures, and these are essential for achieving a desired strategic option. And so in a balanced scorecard, we look at each of these as a key performance measure. And the companies would be the ones who would set up and try and distinguish what key performance measures they want to have on their balanced scorecard. So they kind of construct their own balanced scorecard to their needs. Okay, so having the chairman and the CFO, it can be instrumental feedback. And what we would want is 4 key areas. Company performance. So we definitely want to know how the company's doing. The leadership of the organization. The management, we learned in the previous chapter different management organization styles. Team building and management succession. How is it building cross-functional teams? What's in place as a plan for management succession? And leadership of external constituencies. And this is looking at the leadership of the external suppliers, external businesses, things outside the internal business. Management audits. This is another way of implementing controls. Developing evaluation activities that would look at the manager's corporate social responsibility, functional area, marketing department, finance department, human resources, and even divisions such as international divisions, local divisions, different product divisions. And it's a useful tool for the board of directors to evaluate how management is handling different corporate activities, different circumstances. So they can do an audit of the managers and set up some protocols of how they want to rate and evaluate the managers throughout the company. A strategic audit is generally a checklist of questions by specific strategy or area or issue that we can take a systematic analysis of corporate functions and activities that are going to help lead to that are in place to help achieve this particular strategy. Now, it's a diagnostic tool. It's very useful for pointing out huge problems and highlighting organizational strengths and weaknesses. So a strategic audit is really something where the management of the company is going to take a close look at the company's operations, the different things that the company does to get an up-to-date view of how they're performing. Responsibility centers. We could look at the company's defined where and how they want to have these responsibility centers. So you could have them at the product level. You can have it at a business unit. You can have it at a department. And they are used to isolate and separate one piece of the company from the rest of the corporation for valuemental reasons. Now, these entities will have their own budget, and valuation will be based on their resources allocated to them in the budget, and then what they produce from these resources. So the top management a manager will be set aside to be responsible for a particular area, however the company wants to slice and dice their responsibilities, and they'll be the ones responsible for the performance of these responsibility centers. Typical responsibility centers, it could be the standard cost centers, revenue centers, expense centers, profit centers, and investment centers. So let's go over each of these a little bit more detail. The standard cost centers these are generally in manufacturing, and what we do is we apply standard costs for each operation or product. So we look at historically, what did it cost us to do this, to make this product, to set this department up, to advertise this product. So we set up a benchmark of performance that's the standard cost. And then as the company goes through the year, we look at the actual cost in comparison to the standard cost to see if we went above or below what we did last year. Revenue centers, this is usually in terms of units or dollars in sales, and we're going to measure the revenues against certain resources, for example, salaries. And the center is judged in terms of the effectiveness rather than the efficiency. So the effectiveness of a sales region, for example, so if we have a revenue center, it could be a state, a county, a territory for a sales manager, and we want to see that the sales have been increasing for this particular area. So we could have a revenue center, however we want to define it, and we could see our sales higher this year than last year. And this gets complicated for companies that have a lot of products, because you would want to look at the revenue center may include 700 different products, and you have to do analysis in every product in each individual revenue center to see what products are doing well where, which products are not doing well, and then decisions can be made such as, okay, our franchises are not doing well in Oklahoma, close those operations. Our closing stores at the Gap, see certain locations at these malls are underperforming, close those, open these new locations in these cities and centers where our close or our profits are expanding. Expense centers, this is resources are measured in dollars without consideration for service or product costs. So we're looking at the expenses for, discretionary expenses that are not typically tied to a particular product, but are more administrative or service. It could be a research department. So they cost the company money, but they indirectly can contribute to revenue. So if we're developing products, we're engineering, we're different administrative activities such as marketing, these are going to be, the expenses are going to be kept tracked up. We're going to keep track of them. Hopefully we could tie the expenses to overall company performance. We'll see that, are we spending more this year in research development, and what do we expect to get out of that? So if research development results in new products or enhanced product features that sell more products, then we could measure that those expenses were worthwhile. Now, profit centers are looking at performance based on revenues and expenses typically established for a smaller unit. It could be a product, a brand, a group of products, or an organizational unit, a business unit. So we look at the resources, products or services that they produce against the costs, direct costs, to see what exact profits these particular centers are making. And these are different ways that we can give responsibility. So you could have the responsibility over a particular line of soda, and we can assign a profit center to that line of soda, and then that way all the expenses that are incurred for that soda line can be in there, and we could draft sort of like a mini income statement just for specifically for that product center. Okay, benchmarking. Benchmarking is a way of measuring product and services against tougher competition. Different companies are recognized as the industry leader, so we want to benchmark ourselves against the, this is the number one brand, this is how much they sell, let's benchmark our performance against that brand, and we're trying to catch up in profits and sales and scope and reach. So benchmarking is a way of really just measuring yourself against the competition. So what we want to do is, 1, identify the area or process to be examined. 2, find behaviors and output measures that we want to measure. 3, select accessible set of competitors to form a best practice list. Calculate the differences among companies' performance measures and those of the competitors, and determine why the differences exist between you and the competitors. Develop tactical programs to close the gaps of performance, so using the information for the benchmark to figure out a solution to get closer to the industry standards, and implement programs to compare the results. In some cases, you may want to, if you meet or exceed the benchmarks, you may want to look at yourself last year's. If all the competitors are doing worse than you, then you can use your last year's results as your benchmarks for this year to improve upon. Okay, enterprise resource planning, or ERP. This is companies like SAP, PeopleSoft, JD Edwards. This is one computer program that runs the entire company. So it unites the company's major business activities within a single family of software. And SAP is a great example of this. And SAP does everything: your human resources, your accounting, your marketing, your production, your warehousing, your purchasing, your costing. Everything is provided through the SAP. Now, the advantage of it is sort of a synergy. Instead of having 27 different computer systems running the company, you just have one. So there's one computer system where if purchasing puts in an order to purchase a product, then accounting knows exactly what's going to happen and has a better estimation of expenses that are going to be spent. So everything is happening in real time. As products are sold, inventory is moved, orders are placed, everything is in the system at once. So at any one particular point in the day, a manager could pull up a report and see how much have we sold today, what's the inventory, what's the amount of purchases, accounts receivable, payable, accounts payable, inventory levels. It makes it very easy to manage your company because all the information are at your fingertips and all the information is interconnected together. So once one activity happens, a product's moved from one shelf to another shelf, then the accounting system will take care of allocating where the money is based on where the inventory is. So it's a very efficient and a very resourceful system, and the main benefit here is the control and the reporting you get from having everything on one computerized system. So that way it eliminates a lot of redundancies, eliminates the breakdown of communications between different programs, and really helps to run the company in a very efficient way. There's also radio frequency identification, RFID, and these are tags you can place on inventory to improve your supply chain effectiveness. So the manufacturer can have RFID chips on all the major components. So at any one time, they can call up the computer, okay, here's our inventory list, this is where everything is. Even if someone went in the night before and secretly moved everything around, RFID will transmit back to the receivers exactly where every piece of inventory is, and exactly where it is because it's a physical location tag. So you'll know where everything is. So it's a very useful for tracking inventory and products throughout the supply chain. Think of this idea. What if there was a supermarket where every product in the supermarket had an RFID sticker on it? So every time you put a product into your shopping cart could automatically tell you how much you spent so far. And then when you go to check out, the shopping cart could relay the information to the register, and nothing would have to be scanned or looked at or checked. You just push the cart right through the register, pay with your credit card, and go. Because the RFID tags would tell your cash register as well as your shopping cart everything that you purchased and the total price of everything. At the same time, these RFID chips or tags would update the inventory. So if you're a supermarket and you sold 14 cans of Campbell's soup and you know that you only have 3 cans left, immediately information can be sent to a warehouse and a new order of Campbell's soup can be on the way. And this is one of the reasons that companies like Walmart and the military, which isn't a company, but they use RFID tags to help reduce the amount of inventory at hand at particular locations. So Walmart may not have a lot of inventory on the shelf. They have just enough what they would look at with typical 2 or 3 days worth of sales on the shelf. And as soon as inventory gets low, a new shipment is automatically being packaged and ready for shipment from the distribution warehouse right to the wall bounds. So that way wall bounds can have less inventory in the stores, which help reduce overall costs for the company, because inventory is money that you had to spend to get the inventory that's sitting there. If you had 2 months worth of inventory on the shelf, it's not as efficient as having a week's worth of inventory. And the fact that they can make shelving space smaller and they can devote more of the store to many different products and less of the store to warehousing and stocking products in the back. So RFID is the only drawback to these RFID chips is the cost. They are kind of expensive, so it's really hard to have them on everything. Okay, divisional and functional IS support. So information systems can be a group or division in the company that helps reinforce business strategy through collection and organization and processing of business information. So you want to have divisional and also functional IT support or information system support to help utilize and collect information and display it in a usable reporting or analysis methods. So problems in measuring performance, sometimes there's a lack of quantifiable objectives to measure certain performances. You just may not be able to tell how satisfied the customer is or what level morale is. Some things are not easily measured. Inability to use information systems to provide timely and valid information. Sometimes you just don't get the information soon enough for what you need. Sometimes the information is incorrect or wrong. And these are problems with measuring performance. If we look at short-term objectives or orientation, Long-term evaluation may not be conducted because of executives. So they may not realize the importance. They don't believe short-term considerations are more important than long-term considerations. They believe short-term considerations are more important than long-term considerations, aren't personally evaluated on a long-term basis, and don't have the time to make the long-term analysis. This has been a constant criticism of a lot of companies, is that they focus too much on the short term and not enough on the long term. So short-term objectives like this quarter's sales, this month's profits, this quarter's earnings per share, that may be looked at or measured too much, and then the long-term goal of building a company that's going to have longer-term growth in sales and profits may be neglected to meet the shorter-term goals. And that's a real problem. They need to set up your performance and your measuring systems to reward long-term goals just as much as the short-term goals. And goal displacement. Sometimes there's a confusion of where the goal starts and ends. The activities that are intended to help be measured and managed by managers sometimes don't always obtain the corporate objectives in the end themselves. They're adopted to meet other ends for which they were not intended, and sometimes the goal of what you're really trying to do gets misplaced. So you may have a goal to lower costs, but then you're lowering the wrong type of costs, which is leading to further problems. So maybe they're lowering the quality of the product to lower costs, but then that's leading to bigger customer dissatisfaction. So that that can sometimes happen, and that's a real problem. And that's why managers need to be focused on these issues, that they can help to better improve them. Now, behavior substitution. This is a phenomenon when people substitute activities that do not lead to goal accomplishments for activities that do lead to goal accomplishments, because the wrong activities are being rewarded. So if you're rewarding the wrong set of activities, sometimes the activities that do matter are being neglected because people are all focused on the activities they're going to be rewarded for, and they're neglecting the activities that they're not. For example, if you're going to reward employees that keep a clean desk and not reward employees that produce a lot, you may look at two employees. This employee has a messy desk, although he does 10 times the amount of work than another employee who has a clean desk. That may take the other employee who has a messy desk may suddenly spend half his day keeping his desk clean, and his output drops by 50%. So that would be a behavior substitution that we don't want. Okay. This is a slide for behavior substitution. I was behind the slide. Sorry about that. Okay. So penetization. It's a hard word to say, but it refers to the phenomenon of unit optimization, its goals, accomplishment, to the determinant of the organization as a whole. So the emphasis on large corporations develop separate responsibility centers to create that can create some problems for the corporation as a whole, to the extent that the division or functional unit views itself as a separate entity. This might refuse to cooperate with other units or divisions in the same corporation if the corporation could in some way negatively affect the performance evaluation. So sometimes the company may not be working together as one, and they may be competing against each other and to accomplish goals that are not going to be, you're sort of competing against your brother and sister or organization units, and you're not thinking about the company as a whole. Okay, so guidelines for proper control. 1, controls involve only the minimal amount of information needed to get a reliable picture of events. So we don't want to over-analyze or over-collect data. We just want enough data to be able to get a picture of what's happening. 2, controls should monitor only meaningful activities and results regardless of the measurement's difficulty. So that means, if we want to look at measuring and being involved with activities and results that really matter, even if it's very difficult to measure them or get a real true idea of what's happening, we still have to try. Controls should be timely so that corrective action can be taken before it's too late. So controls, in no sense getting a report a year after the project is done. You want the control to be as timely and relevant as possible. long-term and short-term goals should be used, and there should be an emphasis. There should be a special focus on long-term goals that they are going to be evaluated, and people are being responsible for them. And it's not just short-term goals, which can get in the way of success of long-term issues. Control should be aimed at pinpointed exceptions. So, in some cases there are exceptions. So only activities or results that fall outside of a predetermined tolerance range should be a call for action. All right. Emphasis on the rewards of meeting or exceeding standards rather than punishment for failing to meet the standards. So we really want to reinforce the positivity of achieving your goals and making your goals, such as raises, bonuses, recognition, and there shouldn't really be a punishment. Maybe there should be a recognition of a failure or discussion, but employees shouldn't. Negative reinforcement in these control circumstances have seemed to be counterproductive for company profits. Okay, so approaches to strategic incentive management. So if we want to incentivize employees to do well, we can have a weighted factor method. So a weighted factor method is particularly appropriate for measuring and rewarding the performance of business units and managers and group level executives when performance factors and their importance vary from one business unit to another. So using portfolio analysis, one's corporation measurements might contain the following variations. We could look at high performance business units a certain way, a cash cow a certain way. These type of things were discussed in the previous chapter, but we want to weight factor how we're going to measure success based on the unit's position in its products. I think I have a chart on that. Yeah, this is the chart where if it's a star, these are the measures we want to look at measuring for the star products. However, for a question mark product, maybe we want to look at market share growth rather than market share. And for cash cows, we would have a different set of circumstances where, and then the dogs, maybe we look on return on assets as a different percentage. So we put these percentages: return on investments is 50%, cash flow is 50%. But for a cash cow, we're not really that concerned on return on investment. We're more concerned on cash flow. We put 60% of the emphasis of meeting this goal on cash flow and 20% on market share. Where a dog, we wouldn't measure market share at all. So this is just sort of a way of realigning this chart, this business strength and competitive position chart, to meet these weighted factor methods. Okay, long-term evaluation method, and this is going to compensate manager for achieving objectives over a multi-year period. So setting up a system where executives are promised some sort of reward for longer-term performance. It could be a stock option. If the company gets to this level in 5 years, you're going to be able to receive 5,000 shares of stock at $1 per share. And strategic funds management. This encourages executives to look at developing expenses as being different from expenses required for the current operations. So an accounting statement for a corporate unit enters strategic funds as separate entry below the return on investment. So if we're looking for funding some type of strategic funds for increasing research, development, or innovation, we want to take them out of the return on investment so they're not evaluated until they actually become a more successful long-term objective, and then we can incentivize them at a longer-term position. So, for example, say we begin the total sales of a unit is $10 million, and we subtract the cost of goods of $5 million, leaving a gross margin of $5 million. Subtract the administration expenses of $2 million, and leaving a return of profit or investment of $4 million. So this is like a standard accounting procedure, and strategic funds approach goes one step further by subtracting an additional, say, $500,000 of strategic funds or developing expenses that we're not going to, we're going to take out and reflect upon to see how these strategic funds are utilized to improve the performance of a company. And strategic funds are something that's going to be outside the normal expenses of the company. All right. So different approaches for strategic incentive management. Again, segregate strategic funds from short-term funds. So strategic funds are more at growing the company, more at initiatives. So we don't want to measure them the same as short-term funds. Develop a weighted factor chart for each business unit. And they don't have to be based on this design. They could be based specifically on how your company separates its business units and how you want to look at performance per business unit. And you want a weight factor, which means develop a percentage between different measurements for what you feel the more important measurement should have a higher percentage. Then measure performance based on pre-tax profit, weighted factors, and long-term evaluations of the business unit's performance. So we're really trying to incentivize here by letting the managers make strategic decisions with funds and then measuring them appropriately for what areas their divisions should be most important to how they contribute to the company, and then measure the performance on the pre-tax profit utilizing those factors. Okay, so that is it for Chapter 11. And just to recap Chapter 11, it's all about the basic idea is the company has a strategic initiative, a mission, a strategy, and it puts it in place. How do you know it's working? Well, you don't know it's working unless you evaluate performance. How do you keep the company performing well? Well, control. So you need controlling your employees, your suppliers, your business environment, some controls to see. Basically, controls are gauges or indicators that give you an idea of what's happening. Just like if you're in your car, your controls are your gas gauge, your heat gauge, your miles, your speedometer, things of that nature give you the controls. The evaluation is really taking a chance to look at how things are going. Evaluation in your car, how are the tires, how's the interior, how's the engine, what's the oil at. So it's really about companies taking the time to look at what's happening, evaluate the good and bad of this, and then making changes to improve it. And this chapter is the basics of kind of going over that information and detailing what companies can do or what companies do to make sure that their strategies are on track to succeed, and the controls are what keeps the strategies, if it was a train, on the tracks, and the evaluations would help the train to maintain its course or improve its speed. Okay, so that's the 11th and last chapter of this text. And I hope you enjoyed these last 11 chapters, and I look forward to your feedback. Thank you.